Imagine you're walking past a brand new restaurant in your neighborhood, and this place is just absolutely packed.
Right, like line around the block kind of packed.
Exactly. I mean, people are scrambling for tables, and through the window, the kitchen looks like an absolute chaotic blur of activity. So you look at the menu taped to the glass, and they're selling millions, literally millions of $1 cheeseburgers.
Wow.
Yeah. But tucked away at the very bottom, in, tiny print, they also offer a $50 steak. So looking at that massive crowd and the sheer volume of food flying out the door, you'd immediately assume this place is an absolute gold mine.
I mean, anybody would. It looks like a massive success.
Right. But what if they're only selling about three of those $50 steaks a night? And worse, what if the cost of the beef, the bun, the cook's wages, and like the building's rent means they're actually losing a few pennies on every single $1 burger they sell?
That's a recipe for disaster.
It totally is. They look incredibly busy, right? Their sales volume is astronomical.
Right.
But they are actively bleeding cash with every single order. And today we're doing a deep dive into a stack of, frankly, fascinating financial analyses and real-world case studies from the Nifty 50, which is the flagship index of the Indian stock market.
It's a great data set for this.
It really is. Because our mission today is to uncover this massive corporate illusion. We're going to explore a hidden financial mechanism that dictates why selling more, like why experiencing record-breaking explosive revenue growth can actually push a massive company right to the edge of bankruptcy.
Yeah, and that restaurant scenario.
Yeah.
It plays out in corporate boardrooms constantly. I mean, all the time.
Really?
Oh, absolutely. The assumption that more sales automatically equals more financial health is, well, it's perhaps the most dangerous myth in business. Top-line revenue, which is simply the total amount of money a company brings in from all its sales, is really only half the story.
And usually the deceptive half, right?
Exactly. The true driver of a company's survival, the engine that actually keeps the lights on and funds future innovation, is this concept known as product mix.
Okay, let's unpack this, because product mix sounds like, I don't know, one of those incredibly dry corporate buzzwords that just puts people to sleep.
Fair enough, yeah.
But based on these sources, it is actually the silent killer of massive enterprises. So if we step away from the jargon for a second, what exactly are we talking about here?
Think of it simply as the specific proportion of different things a company sells within its total sales volume. In your restaurant analogy, it's the exact ratio of those cheap burgers to the expensive steaks.
Got it.
Because in the real world, not all revenue is created equal. A dollar brought in by one product might leave you with 50 cents of pure profit,
Right.
while a dollar brought in by a totally different product might leave you with, like, 2 cents. So understanding how a company's specific blend of products influences its operating margins, that is the absolute key to separating a dominant, highly resilient business from, well, a desperate corporate illusion.
So we really need to ground this in the math of operating margins. When we hear that term thrown around on financial news networks, it's usually just treated as a scorecard. Like, oh, their margin is up.
Right, just a random number.
Exactly. But let's look at the actual gears turning underneath.
Well, to find your operating margin, you take your total revenue,
Right.
so all the money coming in, and you subtract your operating expenses.
Okay.
That means stripping out the variable costs, like the raw materials, the steel, the wheat, the plastic, and then you also strip out the fixed costs,
Which would be like what?
like the massive rent on your manufacturing plant or all the administrative salaries. Whatever cash is left over after all that, expressed as a percentage of your total revenue, is your operating margin.
Okay, and the sources break the things a company sells down into two main categories that drastically alter that percentage.
They do, yeah.
First, you have what they call high-margin accretive products. These are your $50 steaks. They're premium items, high-end variants, specialized services, or products built on proprietary technology that literally nobody else has.
Right, the stuff that's hard to replicate.
Exactly. The key here is pricing power. People really want them, and they're fully willing to pay a premium.
And they're called accretive because every single time one of those leaves the shelf, it pulls the company's overall average profitability upward. It's doing heavy lifting.
Nice.
But the danger, and this is where companies get into trouble, the danger lies in the second category, low-margin dilutive products.
The $1 burgers.
Precisely. These are your entry-level items. They are highly commoditized, meaning, there's a dozen other companies making the exact same thing.
So you have to compete purely on being the cheapest.
Exactly. It's a race to the bottom. They are produced in massive volumes. but the profit on each individual unit is incredibly thin.
Which sets the stage for this phenomenon the sources call adverse mix variance, which just sounds intense.
It is intense.
Because if I'm reading this right, this happens when the sales volume of your cheap, low-margin products starts growing way faster than the sales of your premium products. So, like, your total revenue might be going through the roof.
Right, the top line looks amazing.
Yeah, but your blended operating margin, the average margin across the entire business, actually starts to plummet.
That's it, exactly. You could be reporting record-breaking quarterly revenues. I mean, the CEO could be literally popping champagne on the earnings call.
While the actual fundamental profitability of the corporation is just quietly rotting from the inside out.
It's terrifying when you actually see it happen in the data.
Wait, hold on. I need to jump in here because this seems to violate, like, Economics 101.
How so?
We are always taught that volume equals economies of scale.
Right.
If I am churning out 1 million cheap entry-level widgets, my overhead per widget drops to mere pennies. I'm buying raw materials in massive bulk. My assembly line is hyper-efficient. Why wouldn't sheer overwhelming volume make me wildly profitable? Why is selling a ton of something ever a bad thing?
What's fascinating here is that economies of scale have a mathematical floor.
A floor.
Yeah. If the fundamental profit margin on an item is razor thin to begin with because you are forced to price it incredibly low just to beat out competitors, scaling it up to massive volumes doesn't magically create a massive profit cushion.
Oh, I see.
It just means you are doing exponentially more work for the exact same tiny sliver of cash. And when a massive industrial company relies on that kind of volume, they walk blindly into 3 very specific, highly destructive traps.
Okay, let's figure out what those traps look like in reality. If I'm running a sprawling heavy manufacturing company, let's say I make, I don't know, industrial machinery or auto parts.
Good example.
I have gigantic fixed costs, huge factories, robotic assembly lines, massive research and development departments. I have to pay for all of that, whether I sell 1 machine or 100,000 machines.
And that is the perfect setup for the first trap, which is the operating leverage trap. High-margin premium products are fantastic at paying off those fixed overheads rapidly because there's just so much profit baked into a single sale.
Right.
But if consumer demand shifts and your product mix suddenly tilts heavily toward those low-margin cheap items, well, you still have that exact same massive factory rent to pay.
Oh, wow. I see. Because I'm only making pennies on the dollar for each item, I suddenly have to run my robotic assembly lines 24 hours a day, 7 days a week, just to generate enough total cash to pay the factory rent. I'm literally working the machines to death just to break even.
Exactly. And in financial terms, that severely depresses what investors call ROCE, or return on capital employed.
ROCE, right.
Yeah. You have deployed a fortune in capital to build these sprawling factories, but the actual return you're getting on that huge investment shrinks. Why? Because you're moving a mountain of product just to make a molehill of profit.
Okay, so you're running the machines constantly, but what happens when the outside world changes? Let's say inflation hits. The cost of raw steel spikes globally, or rubber suddenly becomes incredibly expensive.
Then you've just walked right into trap number 2, the inability to pass on input costs. By definition, your entry-level, low-margin products are hyper-price sensitive.
Because the only reason the customer is buying them is because they are the absolute cheapest option on the market.
Exactly.
So if my cost to buy rubber goes up, I can't just slap a higher price tag on my budget tires to compensate. If I raise the price even by a few dollars, my budget-conscious buyer they just go to a competitor. Or they decide they can stretch their old bald tires for another 6 months. The demand just evaporates.
And remember, the margin was already paper thin. Your costs went up, your price couldn't, and that tiny sliver of profit gets completely squeezed out of existence. You are now actually manufacturing at a loss.
Man. Which leads to a really terrifying scenario trap number 3. Because you're relying entirely on volume to make any absolute profit, you have to manufacture millions of units.
Right.
And to build millions of units, you need an ocean of raw materials. You have to hoard huge quantities of steel, plastic, electronics, just to keep these assembly lines fed.
And buying that ocean of raw material takes an incredible amount of cash, which introduces working capital strangling.
Working capital strangling.
Yeah. Your cash isn't sitting in a bank account where you can use it to pay off debt or, invest in new technology. It is physically trapped in massive warehouses full of raw inventory.
It's like trying to run a marathon, but for every mile you run, you have to strap another 10-pound weight of supplies into a backpack.
That's a great way to put it.
Sure, you might still be moving forward, your revenue is growing, but the sheer crushing weight of the inventory required to keep moving is going to suffocate you. You might look like a giant company on paper, but you are constantly desperate for liquidity.
And if there's even a minor hiccup in the global supply chain or a sudden dip in consumer spending, that heavy backpack pulls you straight to the ground.
So we've laid out a pretty bleak picture of the traps. But physical manufacturing companies do survive and some actually thrive.
They do, yeah?
Let's look at how a massive manufacturer actually steers the ship away from a toxic product mix. The sources provide this sort of masterclass from the Indian auto sector, specifically looking at Maruti Suzuki.
Maruti Suzuki is an incredible real-world case study.
Yeah.
For a very long time, their product mix was heavily anchored by entry-level mini and compact cars. Think of models like the Alto or the Wagon R.
Right.
These are the textbook definition of high-volume, low-margin products. I mean, they were the absolute king of the budget car.
But the market doesn't stay static. The sources note that rural demand, which drove a lot of those entry-level sales, well, it began to soften.
Yeah.
And simultaneously, consumer tastes structurally shifted. Middle-class buyers suddenly wanted sports utility vehicles. They wanted SUVs.
So Maruti Suzuki's executive team was staring down at cliffs. Their high-volume engine was sputtering. And the instinct for a lot of companies would be to panic, slash prices on those entry-level cars even further, and try to force the volume back up through massive discounts.
Which, based on everything we just discussed, would have just accelerated the margin collapse.
Entirely. But instead, they aggressively pivoted their entire product mix. They poured their focus into expanding a higher-margin SUV portfolio, pushing models like the Brezza, the Grand Vitara, and the Franx.
The discipline required to execute that shift must be remarkable.
It really is. Even as their massive legacy business of entry-level hatchbacks experienced sluggish growth, they just didn't panic. By intentionally forcing their sales mix toward premium products with pricing power, they successfully expanded their overall operating profit margin toward around 13% in recent fiscal cycles.
Wow.
Yeah. They sold fewer total cars in certain segments, but they made significantly more money on the cars they did sell.
Here's where it gets really interesting, though. We just established that shifting to higher-end premium vehicles is the way to boost margins.
Right.
So electric vehicles, EVs, must be the ultimate margin booster, right? I mean, they're high-tech, they are the future, they command a premium price tag.
You would think so.
But the sources highlight a massive wrinkle here called the EV paradox.
It seems completely counterintuitive. You would assume selling the technology of the future would instantly make you wildly profitable. But you have to remember the mechanics of scale.
Okay.
The supply chains for traditional internal combustion engine vehicles have been optimized over a century. The parts are cheap, they're locally sourced.
Right. Building a standard gas engine block is highly efficient today, but the localized supply chains for EV batteries are still in their infancy in many regions. Importing rare earth materials, developing entirely new high-voltage architectures, the component costs are just astronomical.
Exactly. So in the current market, the actual profit margin on an EV is often significantly lower than its gas-guzzling counterpart.
That puts automakers in a bizarre position. If a legacy automaker successfully markets their new EV lineup and suddenly a huge percentage of their total sales are electric, they are going to dominate the headlines. They are, quote-unquote, winning the future. But because that mix shifted so heavily toward EVs, their blended operating margins will actually drop. They are financially penalized in the short term for successfully selling the future.
If we connect this to the bigger picture, it illustrates the absolute tightrope that executive management walks every day. You have to capture market share in EVs, or you will be totally obsolete in a decade.
Right.
But if you transition your factories too quickly, before localized battery manufacturing can scale up and drive those component costs down, you destroy your company's operating margins today. It requires a flawless balancing act.
Using the high margins from your legacy premium gas cars to sort of subsidize the temporarily low margins of your EV lineup.
Exactly. Until the EVs finally achieve mature economies of scale.
That makes perfect sense for physical manufacturing, cars, factories, steel. But what happens when a company sells entirely unrelated things? What if the product fix isn't just different models of cars, but wildly different industries altogether?
Like what?
Like, say, cigarettes and wheat.
Oh, then you look at a company like ITC Limited. They are a fast-moving consumer goods giant, and they provide a stark example of how a fractured product mix can create a massive illusion of growth.
ITC has a fascinating revenue breakdown. Let's look at their cigarette segment. According to the sources, cigarettes contribute a moderate portion of their total revenue, roughly 40 to 45%. But the profitability is staggering.
It really is.
They carry an EBIT margin earnings before interest and taxes of roughly 60 to 70%.
Let's clarify EBIT for a moment, just so we're all on the same page.
Yeah.
It's essentially the raw operating profitability of that specific division before the corporate accountants start dealing with debt interest or government taxes. A 60 to 70% EBIT margin is a cash-generating absolute monster. It is the anchor of the entire corporation.
But then you look at the rest of the company, the others category. This includes packaged foods, agribusiness, and hotels. Collectively, these segments actually bring in the majority of ITC's total revenue, about 55 to 60%.
But the margins here are entirely different. We are talking single digits to mid-teens. Agribusiness, dealing in bulk commodities like wheat or leaf tobacco, operates on razor-thin margins.
So imagine a hypothetical quarter. ITC's agribusiness has an incredible run. They secure massive global contracts and export a record-breaking amount of wheat. Their paperboards division also has a stellar quarter. The sheer volume of goods moved is unprecedented.
Okay, so a lot of activity.
Right. But during that same quarter, cigarette sales just remained flat. No growth. If I am looking at the top-line revenue, the total cash swing in the door, it looks like ITC just had a blockbuster quarter. Total revenue is booming.
But the blended operating margin for the whole company just shrank dramatically
Wow.
because the proportion of total sales tilted heavily toward the absolute least profitable things the company does.
So if I'm an amateur investor, I might read a headline that says ITC revenue surges 20%, and I think, wow, incredible growth, I'm buying the stock. But I am completely missing the illusion.
You are buying into vanity. Savvy investors look straight past that surging top-line number. They drill deep into this segment-wise revenue breakdown.
Because if that 20% revenue growth was entirely driven by low-margin wheat, while the 70% margin cigarette engine just stalled out, the actual absolute profit dollars generated by the company might not have grown at all.
Precisely. Tracking how those specific segments change quarter over quarter is the only way to know if a company is building sustainable wealth or just inflating its volume.
Taking that a step further, this dynamic isn't isolated to physical goods. The sources also dive deep into the tech sector, specifically looking at massive IT services firms in the Nifty IT index, like Infosys, Wipro, and HCL Tech.
Right, a totally different world.
In this world, you aren't selling burgers or cars. Product mix translates directly to service mix.
And the divide in the service mix is profound. On one end of the spectrum, you have legacy maintenance contracts. This is the grunt work of IT, keeping the servers on, managing basic infrastructure, fixing application bugs. Over the past decade, this has become highly commoditized.
Meaning any competent IT firm on the planet can do it. And when anyone can do it, the client just looks for the absolute lowest bidder. It's a race to the bottom on price. So legacy maintenance inherently carries significantly lower margins.
But on the other end of the spectrum, you have high-end digital transformation, implementing complex cloud architectures, building generative AI platforms. This requires highly specialized talent, and clients are willing to pay a massive premium for it. That is your high-margin work.
And the sources detail how the global macroeconomic environment can forcibly shift this mix practically overnight. Let's say inflation spikes in the US and Europe, or there are widespread fears of a looming recession.
Which happens.
Global enterprises get nervous. They tighten their belts.
And the first thing a nervous enterprise does is pause their discretionary spending. They tell their IT provider, look, we don't need a custom AI chatbot right now. Put that high-end project on ice. Just keep the servers running so we don't go offline.
Oh, man. So the IT firm service mix instantly suffers an adverse shift. They are suddenly heavily reliant on those cheap, low-margin maintenance contracts.
Yes, but the math gets even more brutal.
How?
Well, the sources note that even during a spending slowdown, these tech companies inevitably face employee wage hikes. You still have to pay your top-tier engineers more every year to keep them from leaving to a competitor.
Oh, of course.
So your costs are rising due to wage hikes, but your client is demanding discounts on commoditized maintenance contracts, and all your premium AI projects are paused.
Yeah.
Historically, across major Nifty IT players, this exact dynamic has triggered massive 100 to 250 basis point contractions in operating margins.
That's huge.
It is. The company might still be signing multi-million-dollar maintenance deals and boasting about total contract value, but the actual profitability of the firm is being severely squeezed.
It is incredible to see the exact same financial physics that apply to a $1 cheeseburger apply to a billion-dollar AI contract.
It's all the same math.
Whether it's an automaker agonizing over localized battery supply chains, an FMCG giant balancing cigarettes against wheat, or a tech firm navigating a recession, the constraints are universal.
Absolutely universal.
If you want to see a deeply practical breakdown of how management teams fight these battles on the front lines, our sources highly recommend reviewing the analysis titled Automobile OEM and Supplier Margins. It provides a really granular look at how shifting market demand forces major manufacturers to completely tear down and rebuild their underlying strategies just to stay afloat.
This is definitely worth a read.
So, what does this all mean for you, the listener? Ultimately, a company is only as healthy as the specific ingredients making up its revenue pie. The top-line revenue number on a glossy earnings report is just the crust. The actual filling is the product mix.
Right.
And if you realize that the filling is made entirely of low-margin, dilutive products, well, that pie is going to leave you incredibly hungry. The absolute golden rule here is simple. Revenue growth is vanity, but operating margin is sanity.
This raises an important question, though, a thought experiment to take with you as we look beyond traditional industrial manufacturers and legacy tech firms.
Okay, let's hear it.
If the ironclad rule of finance is that revenue is vanity and margin is sanity, how should we view the modern ecosystem of tech startups and blitzscaling?
Oh, that's a fascinating lens. The entire model of operating with deeply negative margins for years, like intentionally selling your service at a massive loss just to acquire millions of users.
Exactly. They are intentionally engineering the worst possible product, mix-selling dollar burgers for 50 cents, just to capture market share, hoping they can figure out the profitability later.
Right.
But at what exact point does the music stop? When does the grace period of venture capital end, forcing management to finally abandon the vanity of user growth and confront the sanity of their actual margins? It is a critical perspective to keep in mind the next time a highly celebrated tech unicorn boasts about record-breaking multi-billion-dollar revenue growth while still quietly failing to turn a single dollar of actual profit.
It really makes you wonder if they're just running the world's biggest, most chaotic restaurant, happily losing money on millions of cheap burgers, just praying that one day, eventually, the crowd might decide to order a steak.
Let's hope they do.
Thanks for joining us on this deep dive. We'll catch you next time.